Welcome. What you're about to hear is a deep, story-driven journey through one of the most important books written about money in the last decade, The Psychology of Money by Morgan Housel. This isn't a book about spreadsheets, investment formulas, or stock-picking strategies. It's about something far more elusive and far more powerful: how human beings think, feel, and behave around money, and why so many smart people still get it wrong. Morgan Housel spent years as a financial journalist watching brilliant economists make terrible personal financial decisions and watching ordinary people with no formal training build extraordinary wealth. He concluded that success with money has very little to do with intelligence and almost everything to do with behavior. Your behavior, your temperament, your relationship with uncertainty, with patience, with fear, and with greed. Over the next few minutes, we're going to walk through every major idea in this book together. We'll hear stories, explore the lessons behind them, and understand why the psychology of money matters to every single person, regardless of how much or how little you currently have. Let's begin. Part 1: No one's crazy. Imagine two people sitting across from each other at a dinner party. One grew up in rural poverty during the Great Depression. The other grew up wealthy in the tech boom of the 1990s. Ask them both whether the stock market is a safe place to invest, and you'll get completely different answers. Not because one is smarter, not because one has access to better data, but because they experience different worlds. This is where Morgan Housel begins, with a deceptively simple but profound observation: nobody is crazy when it comes to money. They're just shaped by their own experiences. A person who grew up watching their parents lose everything in a financial collapse will treat risk entirely differently than someone who grew up watching their parents' investments double every few years. They're not irrational. They're drawing on the only data they personally lived through. Housel gives us the example of lottery tickets. Wealthy, educated people often look down on the poor for buying lottery tickets. It's such a bad investment, they say. The expected return is terrible, and mathematically they're right. But here's what they're missing. For someone who has never had a meaningful chance at real wealth, someone for whom the traditional vehicles of stocks, real estate, and compound interest feel completely inaccessible, a $2 lottery ticket is the only mechanism that offers, however remotely, a shot at a life-changing sum of money. It's not stupidity. It's a different experience of what options exist. This reframes everything. Before you judge someone else's financial decisions, Housel urges you to ask: what experiences shaped them? What world did they grow up in? What risks feel normal to them versus catastrophic? The lesson here is humility. You don't know everything. Your personal financial history is a tiny, unrepresentative sample of how the world actually works. And the sooner you accept that, the more open you become to learning. Part 2: Luck and Risk. The TWINS nobody WANTS to talk about. Now here's a story that stopped me cold when I first read it. Bill Gates attended Lakeside School in Seattle, one of the only high schools in the entire world in the late 1960s that had a computer. Not one of the only high schools in the country, one of the only ones on the planet. The odds of any given student ending up at that school were roughly 1 in a million. Bill Gates was that student. Does this diminish Gates's brilliance? Absolutely not. He was extraordinarily gifted, worked obsessively hard, and made brilliant decisions. But Housel asks us to honestly acknowledge that luck played a significant role in positioning him for that success. The raw material of his genius needed a very specific environment to ignite, and he happened to be standing in that environment. Now consider Gates's childhood friend, Kent Evans. Evans was equally brilliant, equally driven, by all accounts just as likely to have achieved what Gates achieved, but he died in a mountaineering accident before he ever got the chance. Risk, the kind you didn't choose and couldn't control, ended his story. This is the twin nature of luck and risk. They are two sides of the same coin. Every outcome in life is shaped by forces beyond our individual control, and those forces can work for us or against us at any moment. Why does this matter for money? Because we live in a culture obsessed with identifying the formula for success. We study billionaires and ask, what did they do right? We study bankruptcies and ask, what did they do wrong? But if we don't account for luck and risk, we draw the wrong conclusions. We attribute success entirely to skill and failure entirely to error, when in reality, both outcomes contain significant doses of chance. The practical takeaway Housel offers is this: be careful who you admire and what lessons you take from their story, and be careful how harshly you judge failure, including your own. When evaluating financial outcomes, always try to ask, how much of this was skill? How much was luck? Would this strategy have worked in different conditions? Part 3. Never enough: the trap of always wanting more. Let's talk about a man named Rajat Gupta. He was born in Kolkata, India, orphaned as a teenager, and through sheer brilliance and relentless effort rose to become the CEO of McKinsey & Company, one of the most prestigious positions in global business. He was worth hundreds of millions of dollars. He had everything most people dream of. And then he threw it all away by engaging in insider trading, sharing confidential information with a hedge fund manager. He was convicted. His reputation was destroyed. He lost his career, his standing, his freedom. Why? Housel suggests the answer is one of the most dangerous forces in personal finance: the inability to define enough. Gupta spent his career surrounded by billionaires, and compared to them, hundreds of millions of dollars started to feel insufficient. The goalpost kept moving, and in chasing the next level, he risked and lost everything he already had. This is not a unique story. Housel catalogs several others. The pattern is always the same. Someone achieves extraordinary success, but instead of feeling satisfied, they look upward at those who have more, and that comparison breeds a dangerous hunger that eventually leads them to take risks they never should have taken. Here is one of the most important sentences in the entire book: the hardest financial skill is getting the goalpost to stop moving. Modern capitalism is extraordinarily good at making you feel like whatever you have is not quite enough. Advertisements, social media, peer comparison, all of it conspires to keep you dissatisfied. And dissatisfaction is profitable for everyone except you. Housel's counsel is powerful and simple: define enough. Know what it means for you, and once you have it, recognize it. The richest person isn't the one who has the most. It's the one who knows when they have enough and doesn't risk what they have for what they don't need. Social comparison is particularly toxic here. If you earn $100,000 a year and your neighbors earn $200,000, you feel poor. If you earn the same salary and your neighbors earn $50,000, you feel rich. Your actual financial situation is identical in both cases. Only the comparison has changed. And yet comparison dictates how you feel about your money more than the money itself. Stop comparing, define your own enough, protect it fiercely. Part 4. Confounding Compounding: the magic that defies intuition. Let me give you a number and see if it surprises you. Warren Buffett's net worth, as of the time this book was written, was approximately $84.5 billion. Of that staggering sum, $84.2 billion, nearly all of it, was accumulated after his 50th birthday. His net worth at age 50 was a relatively modest $300 million. At age 60, it was around $1 billion. The explosion of wealth came late, very late, and it came because of one force operating over an extraordinary length of time: compound interest. Housel makes a stunning observation here. Buffett is famous as an investor, and people spend enormous energy trying to reverse engineer his stock-picking genius. But Buffett's real superpower isn't picking stocks. It's that he started investing seriously at age 10 and never stopped. He gave compounding an 80-year runway. That's almost incomprehensibly rare. Here's what makes compounding so counterintuitive to the human brain: it doesn't grow in a straight line. It grows slowly at first, almost imperceptibly, and then it explodes. If you invest money and watch it for the first decade, you might be underwhelmed. The numbers don't seem to be moving that fast. But inside that slow, early period, the foundation is being laid for extraordinary acceleration later. Housel says if Buffett had lived a normal life, started investing in his 20s like most people, and retired in his 60s, his net worth would be a few $1 million. Still admirable, but not the Buffett we know. The legendary wealth is almost entirely a product of time, not genius. This has a profound implication for ordinary investors. You don't need to find the best stocks. You don't need to time the market. You don't need to be a genius. You need to start early, invest consistently, and then get out of the way and let time do its work. The greatest enemy of compounding is impatience, the need to see results now, to react to market swings, to chase hot trends. Every time you interrupt the compounding process, you reset the clock. The single best thing most people can do for their financial future is the most boring thing imaginable. Invest regularly in a diversified portfolio and never stop. Part 5, GTTING Wealthy Vs. Staying wealthy, two completely different skills. Getting rich and staying rich require entirely different mindsets, and most people who are good at one are surprisingly bad at the other. Getting rich generally requires optimism, risk-taking, decisiveness, and the willingness to put yourself out there. Staying rich requires almost the opposite: humility, caution, frugality, and a healthy fear of losing what you've built. Housel uses the example of Jesse Livermore, one of the most successful stock traders in American history. Livermore made a fortune, over $100 million in today's terms, by short selling during the market crash of 1929. At a moment when virtually everyone else was being wiped out, he thrived. It was a breathtaking achievement of financial insight and nerve. And then he lost it all, multiple times. He ultimately died broke by suicide, leaving a note that described himself as a failure. The skill that made him great, the aggressive, concentrated, high-conviction betting that drove his extraordinary gains, was the same skill that eventually destroyed him. He couldn't switch modes. He didn't know how to shift from getting wealthy to staying wealthy. Housel argues that the most important financial trait for staying wealthy is survival. You have to stay in the game, and staying in the game means doing three things. First, don't be leveraged. Debt amplifies your wins, but it also amplifies your losses. It turns temporary setbacks into permanent disasters. The person who survives a 50% market crash with no debt will recover when the market recovers. The person who was leveraged may be wiped out before recovery ever arrives. Second, maintain room for error. Never assume the best-case scenario. Always plan for things to go worse than expected, because they frequently will. Leave yourself a margin of safety in every financial decision. Third, stay optimistic about the long term while being paranoid about the short term. You should believe deeply that things will work out over time, because historically they have, while simultaneously preparing for the very real possibility that the near future may be brutal. Housel distills this into a beautiful phrase: I just want to survive. The investors who survive across decades, who are still in the game when the great bull markets arrive, are the ones who win in the end, not because they were the most brilliant, but because they were still there. Part 6, Tails, You Win the Power of Extreme OUTCUMES. Here is a counterintuitive truth that changes everything about how you should think about investing. Most things fail, and that's perfectly okay, as long as a few things succeed spectacularly. This is the concept of tail events, extreme outcomes at the far end of a probability distribution, and understanding it will free you from one of the most crippling anxieties in investing, the fear of being wrong. Housel walks us through the economics of venture capital. A professional venture capitalist might invest in 50 companies. Out of those 50, roughly 35 will fail completely. 10 might return their original investment or make a small gain. 4 or 5 might do well. And one, just one, might become the next Google, the next Amazon, the next Facebook. And that one investment will make up for all the losses and generate enormous returns for the entire fund. This pattern, where a tiny fraction of outcomes drives the vast majority of results, is not unique to venture capital. It appears everywhere in finance, in business, in nature, and in history. Amazon built Amazon Web Services, Prime, and the Alexa ecosystem. Most of its other ventures have been failures or irrelevancies, but AWS alone generates the enormous majority of Amazon's profit. Walt Disney produced hundreds of projects throughout his career. A handful of them, Snow White, Fantasia, Bambi, were transformative successes that funded everything else. Apple's iPhone accounts for the enormous majority of the company's revenue. Everything else is essentially a rounding error. What does this mean for you as an investor? It means that being wrong a lot of the time is not just acceptable, it's expected and inevitable. The investors who succeed aren't the ones who avoid mistakes. They're the ones who ensure that when they're right, the outcome is large enough to cover all the times they were wrong. This is why diversification works. This is why index funds work. You're not trying to find the one perfect stock. You're buying a broad swath of the market, knowing that most companies will be mediocre or worse, and that a handful of exceptional performers will carry the overall return. And this principle applies beyond investing. In your career, in your creative life, in business, most of what you try will not work as well as you hoped. But if you keep trying, keep shipping, keep showing up, the wins that do come will more than justify everything that didn't. The goal isn't a perfect batting average. The goal is to stay in the game long enough that your tails, your extraordinary outcomes, have a chance to arrive. Part 7. Freedom, the HIGHEST dividend money can pay. Let's pause for a moment and ask a fundamental question. What is money actually for? Housel's answer is one of the most clarifying things I've read on the subject. Money's highest and best use is the purchase of something that is genuinely priceless in the modern world: control over your own time. He cites research by the psychologist Angus Campbell, who spent decades studying what makes people happy. The single biggest predictor of happiness, Campbell found, was not income, not education, not geography. It was a sense of control over one's own life, the feeling that you are directing your own days, making your own choices, deciding how your own hours are spent. Think about how much of modern working life is the opposite of that. You wake up when an alarm tells you to. You drive to a place someone else chose, at a time someone else set, to perform work someone else defined, in ways someone else prescribed, for hours someone else determined. You eat lunch when your schedule permits. You go home when you're allowed to. For most people, most of the time, most of their waking hours belong to someone else. Money, accumulated patiently, is the mechanism by which you can buy those hours back. Not all at once. Gradually. First, you might accumulate enough to take an unpaid sabbatical, then enough to work part-time, then enough to choose your work based on meaning rather than salary, eventually enough to not need work for income at all. Housel is careful to note that this doesn't require being a millionaire. It requires building enough of a financial cushion that you have options, that saying no becomes possible, that walking away becomes possible, that choosing differently becomes possible. He tells a story about a friend who could earn an enormous salary at a prestigious but demanding job. The salary would be 6 figures, the status would be impressive, but the job would require 80-hour weeks, constant travel, and near total surrender of personal autonomy. The friend turned it down to work for less money at a job where they controlled their own schedule. Many people judged this as financially foolish. But if you value control over your time, and the research says you should, this was in fact an extraordinarily rational financial decision. The highest return on your money is not a higher interest rate. It's a higher degree of freedom. Part 8, Man in the Car Paradox. Wealth signals don't work the way we think. Here is an uncomfortable truth. No one is thinking about you as much as you think they are. Housel opens this section with a personal anecdote. He used to be a valet parking attendant, and he noticed something fascinating. When an extremely expensive, beautiful car would pull up, a Ferrari, a Lamborghini, a McLaren, the people watching would admire the car. They'd look at it, discuss it, appreciate it, but they almost never thought about the person driving it. The driver was almost irrelevant. The car was the subject of their admiration, not the human being who owned it. He then asks us to examine why we buy expensive things. In most cases, we're not buying them primarily for our own enjoyment, we're buying them as signals to others. We buy the expensive car to make people think we're successful, wealthy, admirable, powerful. But as Housel points out, the observers admire the car and imagine themselves in it. They don't think more highly of you. They think highly of the idea of wealth as applied to themselves. This is the paradox. The things we buy to make others respect and admire us often don't accomplish that at all. What people actually admire is the concept of wealth, and they want it for themselves, not for you. Meanwhile, the person who is genuinely wealthy often looks completely ordinary. They drive a modest car. They wear regular clothes. They live in an unremarkable house. Because they've realized something crucial: true wealth is what you don't spend. Wealth is financial assets that haven't been converted into visible possessions. The millionaire next door, as the famous book describes, looks nothing like what we imagine a millionaire to look like. Because wealth is hidden by definition. The moment it becomes visible spending, it stops being wealth. Housel puts it precisely. We tend to judge wealth by what we see. But what we see is spending, not wealth. The person driving a Ferrari might be deeply in debt. The person driving a 10-year-old sedan might have a net worth of several $1,000,000. If you want to build real wealth, the implication is clear. Stop using your money to signal success to people who aren't paying nearly as much attention as you think they are. Part 9. Wealth is what you don't see. Extending the previous idea. The secret to building wealth is almost aggressively counterintuitive in modern consumer culture. Wealth is not about income. It's about what you keep from your income. Housel makes this point emphatically. If you earn $200,000 a year and spend $200,000 a year, you have zero wealth. If you earn $50,000 a year and save $15,000 of it consistently for 30 years, you have built substantial wealth. The income numbers are entirely different. The wealth outcome favors the person with the lower income. This is why Housel says that building wealth has less to do with income and investment returns, and more to do with your savings rate. The savings rate is almost entirely within your control, regardless of economic conditions, market performance, or your career trajectory. And here is the key insight. You don't need a specific reason to save. Modern financial advice tends to focus on saving for something: a down payment, a vacation, a child's education, retirement. But the most powerful saving is saving without a predetermined purpose, saving for possibilities you can't yet imagine, saving to build optionality. When you have savings, the unexpected event that would have been a catastrophe becomes an inconvenience. The job loss that would have been devastating becomes a transition period. The health emergency that would have been financially ruinous becomes a setback you can absorb. Savings without a specific purpose is the most underrated financial tool in existence. It is liquid, flexible, and powerful, and it becomes more powerful the more uncertainty exists in the world, which is always. The practical implication: live below your means. Not far below, not in misery, but consistently, sustainably below your means. Widen the gap between what you earn and what you spend, and then protect that gap fiercely. Part 10. Save like a pessimist, invest like an optimist. This is one of the most elegant frameworks in the entire book, and it resolves what appears to be a contradiction. On one hand, Housel argues passionately for long-term optimism. History shows that economies grow, markets rise, human ingenuity solves problems, and living standards improve over time. Anyone who has been waiting for the right moment to invest because things seem too uncertain has been waiting forever and will continue waiting forever because uncertainty never goes away. On the other hand, Housel argues with equal passion for short-term caution, maintaining cash reserves, avoiding excessive debt, building margins of safety, and expecting things to go wrong in the near term. How do you hold both of these simultaneously? Housel suggests the key is the time frame. You can be deeply optimistic about 10-year outcomes while being cautious about 10-month outcomes. These aren't contradictions. They're complementary. The optimism belongs in your investment strategy. Stay in the market, buy broadly, hold for decades, trust the long arc of economic progress. The pessimism belongs in your risk management. Keep an emergency fund, don't over-leverage, don't put all your eggs in one basket, prepare for black swan events. This maps onto a broader insight about how the world actually works. Progress is relentless over long periods of time, but it never moves in a straight line. The path from point A to point B, measured in decades, is upward. But the path measured in months or years is filled with terrifying dips, crashes, crises, and corrections. The investor who only sees the long-term trend will be blindsided by the crashes and panic out at exactly the wrong moment. The investor who only sees the short-term volatility will be too frightened to ever invest meaningfully. The wise investor sees both and structures their finances accordingly. Be a long-term optimist with your investment thesis. Be a short-term pessimist with your risk exposure. These two things together create resilience. Part 11. Reasonable BATS rational. Here is a distinction that I think is genuinely important and often overlooked in standard financial advice. There is a difference between what is mathematically optimal and what is humanly sustainable. Housel argues that you should not aim to be a perfectly rational investor. You should aim to be a reasonable investor, and these are not the same thing. A perfectly rational investor, guided by pure mathematics, might conclude that they should hold 100% of their portfolio in equities for decades, never hold cash because cash loses value to inflation, rebalance mechanically on a schedule, and never make exceptions for personal circumstances. Mathematically, this might produce the highest expected return. But human beings don't live inside spreadsheets. We have emotions. We have fears. We have life circumstances that change. We have relationships and obligations and psychological needs. A strategy that is mathematically optimal but psychologically unbearable is a bad strategy because you won't stick to it. And a strategy you don't stick to is worthless. Housel gives an example. Suppose the mathematically optimal portfolio during a market crash is to do nothing or even to buy more. But if that portfolio causes you so much anxiety that you can't sleep, that you fight with your spouse, that you make impulsive decisions born of panic, then it's not optimal for you. A slightly less aggressive portfolio that lets you sleep at night, stay married, and hold steady is the better choice for you, even if the expected return is lower. This principle extends to all kinds of financial decisions. Maybe you invest in your employer's stock even though diversification theory says you shouldn't, because it aligns with your sense of loyalty and purpose at work. Maybe you pay off your mortgage early even though the math says investing that money would yield higher returns, because the psychological freedom of owning your home outright is worth more to you than the mathematical advantage. Do what lets you sleep. Do what you can maintain through crisis. Do what fits your life, not just your spreadsheet. A reasonable plan you actually follow will always outperform an optimal plan you abandon. Part 12. Surprise. History as a misleading guide. One of the most important intellectual cautions in this book. Don't mistake the historical record for a reliable guide to the future. This might seem paradoxical coming from a book that frequently cites historical data, but Housel draws a careful distinction. History is valuable for understanding broad patterns, the tendency of markets to recover, the power of compounding, the damage that debt and leverage can cause. These broad lessons seem durable. But history is a terrible guide to specific future events. And here's why. Every major event that shaped financial history was, by definition, an event that people didn't fully anticipate. If the 2008 financial crisis had been clearly foreseeable, it would have been prevented. If the dot-com crash had been obviously predictable, investors would have sold before it happened. These events were surprises, and that's what made them so devastating. The key insight is that the world is constantly generating genuinely novel situations. Technologies appear that have no historical precedent. Geopolitical events occur that no historical model anticipated. Pandemic diseases emerge. Financial instruments are invented that create entirely new categories of risk. Housel quotes the historian Dan Carlin, who observed that if ancient Rome had somehow survived into the modern era, its citizens would be absolutely bewildered by the world they found. Our world is that different, and it will continue to change in ways we cannot predict. What does this mean practically? It means you should be humble about predictions, both your own and those of experts. It means you should be skeptical of any investment strategy that is entirely dependent on the future looking like the past. And it means you should build into your financial life the expectation that surprises will happen, good surprises and bad ones, and that your plan needs to survive both. The correct response to an unpredictable world is not better prediction. It's better resilience. Part 13. Room for error, the single most important financial concept. If there is one idea from this entire book that I would ask you to tattoo on the inside of your eyelids, metaphorically speaking, it is this: always leave room for error. In engineering, this is called a margin of safety. You build a bridge to hold twice the weight you expect it to carry. You design a building to withstand winds stronger than any ever recorded. You leave space between what you planned for and what reality might bring. In personal finance, most people do the opposite. They plan for the best-case, optimistic income projections, assuming investments will perform at historical average rates, assuming no major unexpected expenses, assuming continued employment, continued health, continued stability. And then life happens. A margin of safety means don't plan to retire at the exact moment you'll have exactly enough money. Plan to retire a few years later, or with a few years more savings, so that a bad sequence of market returns doesn't derail you. It means don't invest every spare dollar. Keep enough cash that if your income disappeared for 6 months, you could continue living without selling investments at the worst possible moment. It means when you run the numbers on an investment, don't assume things go right. Ask what happens if things go wrong. What happens if the expected return is half of what you projected? What happens if you need this money sooner than planned? Housel notes that Buffett has always maintained enormous cash reserves, far more than most analysts think is financially optimal, and many have criticized him for it. But those reserves are exactly why Berkshire Hathaway has survived every crisis, every recession, every market panic of the last 6 decades. When everyone else is forced to sell because they need liquidity, Buffett is in a position to buy. The margin of safety is not a sacrifice of return. It is the price of survival. And survival, as we've established, is the prerequisite for everything else. Part 14. You'll change and so will your goals. Here is a psychological trap that catches almost everyone at some point. We are terrible at predicting what our future selves will want. Researchers call this the end of history illusion. We look back and recognize clearly how much we've changed: our tastes, values, priorities, relationships, beliefs. We can see that the person we were at 22 is almost unrecognizable compared to who we are at 35. But when we look forward, we consistently underestimate how much we will continue to change. We assume that who we are now is more or less who we will always be. This creates a serious financial planning problem. We make long-term financial commitments based on what we value today. We choose careers, locations, lifestyles, and investment strategies around our current identity. And then we change, and the plan no longer fits. The 25-year-old who is passionate about climbing the corporate ladder may, at 40, desperately want to work less and spend more time with children. The couple who loves urban life and plans to stay in a city forever might find, at 45, that they crave a quiet house in the country. The investor who is fearless about volatility at 30 may discover, after experiencing a real market crash, that they have far less emotional tolerance for risk than they ever imagined. Housel doesn't say you can predict these changes, you can't. But he says you can build your financial life in a way that allows for them. Avoid extreme ends. Don't commit so fully to one financial path that changing course becomes catastrophic. Keep some flexibility. Don't lock up every dollar in illiquid assets. Don't structure your life around a salary you must maintain forever. Also, and this is subtle but important, don't be too harsh on your past self for decisions that no longer seem optimal. You made those choices based on who you were and what you wanted at the time. You're allowed to change your mind. The sunk cost of those earlier decisions shouldn't trap you in a future that no longer fits. Part 15. Nothing is free, the price of volatility. Let me ask you something. When you look at the historical returns of the U.S. stock market, you see that stocks have returned roughly 10% per year on average over the long run. That is an extraordinary return. Why doesn't everyone simply put all of their money in stocks and leave it there? The answer is the price, and the price is volatility. Market returns don't come free. They come with stomach-turning drops, periods of years where your portfolio loses half its value, news headlines that make you feel like civilization itself is collapsing, and the constant temptation to do something, anything, to stop the bleeding. Housel frames this brilliantly. He says the volatility of investing is not a fine, not a punishment for doing something wrong. It is the price of admission. It is the cost of receiving those long-term returns. And if you try to avoid paying that price by timing the market, moving to cash during downturns, shifting to safer assets, you will likely avoid the losses, but you will also miss the recoveries. And the recoveries are where the money is made. The investors who earn the best long-term returns are not the most sophisticated ones. They are often the ones with the highest psychological tolerance for sitting still during terrifying periods and doing nothing. Here's a remarkable fact. If you had invested in the S&P 500 over the last several decades and missed just the 10 best single days in the entire period, 10 days out of thousands, your returns would be dramatically reduced. And those 10 best days very frequently occurred right after some of the worst days. The investors who fled to safety during the crash often missed the recovery entirely. Define the cost of the returns you want. Then pay it willingly, knowingly, and without complaint. Every time the market drops and you feel the urge to sell, that feeling is the cost. Enduring it is how you earn the return. Part 16. You and me, different GAMES, different rules. One of the most liberating ideas in this book. Not everyone should be playing the same financial game. Housel tells a story about the dot-com bubble of the late 1990s. At the time, stock valuations reached absurd levels by any traditional measure, and many thoughtful, intelligent financial analysts concluded that these prices were completely unsustainable because they were right. But here's the thing. Some traders, specifically short-term traders, were playing a completely rational game at those prices. If you are a day trader whose entire strategy depends on buying something and selling it tomorrow at a slightly higher price to someone willing to pay that price, then astronomical valuations can be perfectly rational. You don't care about the fundamental value of the company. You care about momentum and short-term sentiment. The long-term investor looking at the same stock is playing an entirely different game. For them, a stock priced at 100 times earnings makes no sense whatsoever. It will eventually collapse. Both of these people can be right within the context of their own game. The problem comes when the long-term investor starts using short-term trader logic to justify their decisions, or vice versa. Housel says this causes enormous confusion and financial damage. Long-term investors see short-term traders making money in an overheated market and start to doubt their own discipline. They start reasoning, maybe these high prices are justified, maybe the rules of valuation have changed, and they start buying overpriced assets, not as short-term traders with an exit strategy, but as long-term holders who are now walking into a trap. Know what game you're playing. Define your investment horizon. Understand your strategy. And stop using advice or benchmarks that belong to a completely different game. The personal finance advice given to a 28-year-old with a 40-year investment horizon is genuinely different from the advice appropriate for a 68-year-old who needs income now. Reading the same financial media, following the same market commentary, responding to the same fears, it creates a false sense that there's one universal game being played. There isn't. Part 17. The Seduction of Pessimism. Have you ever noticed that pessimistic financial predictions get more attention, more credibility, and more airtime than optimistic ones? There's a reason for this. Housel explains that pessimism sounds more sophisticated, more intellectually serious, more like it comes from someone who is clear-eyed about the harsh realities of the world. Optimism, by contrast, gets dismissed as naive or simplistic, like you haven't thought hard enough about the downside risks. But here's the reality. The long-run historical case for optimism in markets and economies is overwhelmingly stronger than the case for pessimism. Anyone who predicted perpetual decline in the U.S. economy at any point in the 20th century was simply wrong. Markets have recovered from every crash. Economies have grown through every recession. Living standards, measured by almost any metric, have improved enormously over decades and centuries. This doesn't mean optimism about specific short-term outcomes is justified. The pessimists who predicted the 2008 crisis were right in the short term, but the optimists who said the economy would recover and markets would reach new highs were also right in the long term. And for most long-term investors, the long term matters more. Housel also identifies an important asymmetry. Bad news travels faster than good news. A market crash happens in days. A recovery takes years. The crash dominates headlines for months. The recovery happens so gradually that it barely registers as news. By the time the market has fully recovered, most people have moved on to worrying about the next crisis. This creates a systematic bias in our perception. We remember the crises vividly. We barely remember the recoveries. And so we chronically underestimate how resilient economies are over time. The lesson: be appropriately skeptical of confident pessimism. Be open to the historical case for long-run optimism. And don't mistake intellectually satisfying doom scenarios for accurate predictions of the future. Part 18. When You'll Believe Anything, Stories and Financial Decisions. We are closing in on the final chapters of this journey, and Housel saves some of his most important ideas for the end. The world, he says, is driven less by logic and data than by narratives, the stories people tell themselves and each other about how the world works. Consider the 2008 financial crisis. At its heart, it was not primarily a failure of mathematics or financial modeling, though those failures played a role. It was a failure of narrative. The story that American housing prices never decline nationally became so widely accepted, so deeply embedded in the collective consciousness of bankers, regulators, and investors, that the entire financial system was built around it. And when the story proved false, the system collapsed. Or consider how stock markets behave. Why does a company's stock price move dramatically on news that is, by any objective measure, only marginally significant? Because stock prices are driven not by the actual financial reality of a company, but by millions of investors' stories about that company's future. When the story changes, the price changes, often far more dramatically than the underlying reality warrants. Housel argues that the most dangerous financial stories are the ones we tell ourselves. When we develop a narrative about why a particular investment will succeed, we don't just hold that belief neutrally, we become emotionally attached to it. We start filtering new information through the lens of confirming our story. Contradictory evidence gets dismissed. Supporting evidence gets amplified. This is confirmation bias in action, and in financial markets, it can be catastrophic. The antidote isn't to stop telling stories. Humans cannot stop telling stories. It's fundamental to how we process reality. The antidote is to hold your narratives loosely, to actively seek out the strongest arguments against your own position, to build portfolios and financial plans that don't depend on any single story being exactly right. Diversification, margin of safety, and humility about the future are all, in a sense, acknowledgments that our stories about the world may be wrong. And building in that acknowledgment is what creates resilience. Part 19. Altogether now the unified framework. As we approach the end of our journey, let's pull all of these threads together. Morgan Housel is not giving you a formula. He is giving you a philosophy. And the philosophy, synthesized, looks something like this. Money is a tool for freedom. Its highest purpose is control over your time. The path to that freedom runs through a savings rate that is higher than your peers, not because you're depriving yourself, but because you've internalized that visible consumption doesn't actually impress people the way you think it does, and freedom is worth more than a nicer car. Compounding is the most powerful force in personal finance. It requires patience measured in decades, not months. It rewards those who start early and never stop, and it punishes those who interrupt it by chasing returns or reacting to short-term noise. Survival is the prerequisite for everything else. You can't benefit from compounding if you're wiped out. Maintain margins of safety. Avoid debt that could destroy you. Keep enough cash that temporary catastrophes don't become permanent ones. You don't need to be brilliant. You need to be consistent, humble, and patient. You need to stay in the game long enough that luck has a chance to compound alongside skill. Define enough. Know what you're actually working toward. Don't let the goalpost move indefinitely, driven by comparison and status seeking. Financial satisfaction comes not from having more, but from wanting less than you have. Reasonable beats optimal. A financial strategy you can actually maintain through crisis is worth more than a theoretically superior strategy that you'll abandon when things get hard. Sleep matters. Sanity matters. Relationships matter. Factor them in. You will change. Build flexibility into your financial life so that when your future self has different priorities than your present self, and they will, you can adapt without catastrophe. And finally, the story you tell yourself about money matters as much as the money itself. Approach your financial life with humility about what you don't know, patience about what takes time, and gratitude for what you already have. Conclusion: the most important sentence in this book. Morgan Housel ends with something deeply personal. He describes his own financial life, which is not flashy, not aggressive, not optimized in the way a finance professor might recommend. He and his wife save a substantial portion of their income. They maintain a large cash reserve. They invest in a diversified, low-cost portfolio. They live in a home they could afford comfortably, not the largest or most impressive one available to them. This is not ignorance. Housel is deeply educated in finance. He knows all the arguments for why he should hold less cash, for why he should invest more aggressively, for why his lifestyle could be more expensive given his income. He does it anyway, because it fits his values, because it lets him sleep, because freedom to him is worth more than maximizing every financial metric. And in that personal disclosure is the most important sentence in the entire book, buried quietly near the end, almost understated. The ability to do what you want when you want, with who you want, for as long as you want is priceless. It is the highest dividend money pays. That's it, that's what all of this is for, not the portfolio performance, not the net worth number, not the social status, not proving something to anyone. The freedom to live your life on your own terms, that is the goal. Everything else is in service of that goal, or it's a distraction from it. Final reflection. As we close this 200-minute journey together, I want to leave you with a question, not an answer, but a question that Housel implicitly poses throughout the entire book. What does enough look like for you? Not for your parents, not for your peers, not for whoever you're comparing yourself to on social media, but for you. If you can answer that question honestly, and then organize your financial life around that answer, you will have grasped the deepest insight of this extraordinary book. Money is not the point. Freedom is the point. Relationships are the point. Meaning is the point. Money, managed wisely and patiently and humbly, is simply the tool that helps you get there. Thank you for listening. Go build something worth having and make sure you're actually there to enjoy it. End of summary. The Psychology of Money by Morgan Housel.